Good afternoon, friends. Today we will discuss Unit 11 of International Finance, that is related to international capital budgeting. Before discussing, let me first tell what will be the learning objective of this session. After going through this class, you may appreciate different capital budgeting techniques in overseas projects. You can understand fundamentals of evaluating foreign projects. You can analyze important issues pertaining to cross-border investment and their application in capital budgeting decision. You can explain various methods of incorporating a risk in investment decisions. So these are the concepts of international capital budgeting. Next, what will be the structure of our discussion today? First, I will give an introduction to the chapter. Next, we will discuss different types of international investment. Next, we will discuss benefits of foreign direct investment. We will discuss various considerations in FDI project. We will discuss capital budgeting and in an international context. Then I will give an conclusion, self-assessment questions, and further reading. This will be the structure of our discussion. Friends, in this globalized world, companies are not only investing in their own country, but they are also investing in different other countries to take cross advantage of cross-border market differential. Companies are nowadays investing in different countries beyond their national boundaries. Those are known as overseas investment, cross-border investment, or foreign investment. The main purpose while making foreign investment is to assess the feasibility of the foreign projects. Whether the foreign projects are feasible or not, you have to analyze. So, the foreign investments can be categorized into two parts. One is foreign direct investment or FDI, another is foreign portfolio investment or FPI. These are the two type of foreign investment. Let me first tell you what is foreign investment. The RBI definition tells that an investment made by a person, resident outside India on a repatriable basis in capital assets is known as foreign investment. The foreign investment may be of two types. One is foreign direct investment, another is foreign portfolio investment or FDI or FPI. Normally, the FDI investments are made in form of physical assets. And if the investment is made in financial asset, the investment in financial assets means in the securities of the company must be greater than 10% of the share capital. The basic difference between FDI and FPI is the intention of the investor. In case of FDI, the intention is to make long-term gains, long-term capital gains. But in case of FPI investment, the intention is to make short-term capital gains. The FDI investments are therefore made in physical assets, and if it is in financial assets, it is greater than 10% of any share of any company. Let's take an example. Suppose Microsoft acquire 20% stake in Infosys. In that case, it will be considered as a FDI investment. But if Microsoft acquire 2% stake in Infosys, in that case, it will be considered as a foreign portfolio investment. Because in case of financial investments, it is less than 10% of the paid off capital of the company. So normally FDI investments are long term in nature, FPI investments are short term in nature. FDI investments may be made in form of physical assets or financial assets which is greater than 10% of the share capital of the company where it is investment. But FPI investment is normally in form of financial assets and it is below 10% of the capital of the company where it is invested. Normally, the FDI maybe in case of FDI, there are two countries involved. What are the two countries involved? One country is known as home country. Another country is known as host country. Let's take an example. What is home country and host country? The country where investment flows, from where investment flows, that is known as home country. Let's take an example. Microsoft invest in Infosys. So from where investment comes? From USA the investment comes. So if USA is called home country, and where it goes to India. So India is known as host country. Hence the recipient of the investment is known as host country. So in case of FDI, the two countries are categorized as home country as well as host country. We will discuss what is the advantage of foreign direct investment for home country as well as host country later on. Next, the FDI investments may be of three types. What are the three types of FDI investment? One FDI investment is known as horizontal FDI. Another is known as vertical FDI. Another is known as conglomerate FDI. What is horizontal FDI? In case of horizontal FDI, the foreign firm establish a project in the business line in which it is already existing in a foreign country. Let's take an example. Suppose Coros Steel wants to invest in India. So it is a steel company. Suppose it invests in another steel company of India. So it is known as horizontal FDI. In case of horizontal FDI, the foreign firm invests in the same line of business in which it is already doing. That is horizontal FDI. So in case of horizontal FDI, the firm establishes a project in the business line in another geographical location. What is the main purpose of horizontal FDI? The main purpose of horizontal FDI is to enter into another local market so that it can cut its cost to reduce competition. Next, another type of FDI may be vertical FDI. What is vertical FDI? In case of vertical FDI, the foreign firm invests through downward integration or upward integration. So vertical FDI is form of downward integration or upward integration. What is downward integration? That means if the firm will aim to acquire or establish a unit to which can supply its core business, or unit which may act as a customer for the core business unit, it is known as vertical FDI. Let's take an example. Suppose Tata Coros Steel Company is a foreign company. It acquire raw material from India, from a mining company, and it now invest in that mining company to get uninterrupted supply of raw material. That will known as vertical integration, or that is a vertical FDI. So vertical FDI may be in form of downward FDI or upward FDI, or it is in form of downward integration or upward integration of the business. So what is conglomerate FDI? Conglomerate FDI is a such a type of FDI where the FDI comes The foreign firm invest in such a business which is only related to its core business. That means there is no relationship with the core business and the FDI business. Why this type of conglomerate FDI is done? This type of conglomerate FDI is done to diversify the operation. If the company wants to get the benefit of diversification in foreign market, he may go for conglomerate FDI. Next, we will discuss what are the benefits of FDI. The benefits of FDI can be categorized under two headings. One is benefit for host country, another is benefit for home country. I have told what is host country. Host country is the country to where the FDI is invested, in which the FDI is invested. Suppose Microsoft invest in India, India will be host country and USA will be home country. So what is the benefit of FDI for host country? If foreign investment comes to India, what are the benefits India enjoys? That is benefit for host country. The first benefit is inflows of factors of production. You know there are four factors of production: land, labor, capital, and organization or enterprise. Out of these, land is the immobile factors of production. But labor, capital, and organization or enterprise may flow to different countries. So, with the help of FDI, labor force comes into another country. The capital comes into another country, host country. The entrepreneurial skills comes into the host country. These are the three major factors of production which will flow with the help of FDI to the host country. Second one is improvement in BOP or balance of payment position of the host country. We know that BOP is a statement of inflow and outflow of foreign currency. With the help of FDI, BOP position improves. How BOP position improves? Because it results in inflow of funds. With FDI, funds comes. So in short term, BOP position improves. With the FDI, what happens? The foreign competitiveness of the firm increases. So in FDI industry, next what happens? It creates some sort of export opportunity from the country. Let's take an example. Suppose iPhone decides to set up its plant in India. Apple decides to set up its plant in India and it start production of iPhones in India. So Indian consumer will use the iPhones produced in India, as well as the iPhone will be exported to nearby countries. So as a result of which the export of India will increase through FDI. Second and third benefit is deepening the global economic linkages. With the help of FDI, the globalization takes place. The world is becoming more and more global, and the supply chains are integrated. There will be multinational cooperation. Okay, global supply chain will be explored. It will call for active cross-border cooperation with other facilities operated by MNCs. So these are three major benefits of FDI for host country. Next, we will discuss what are the benefits of FDI for home country. For home country, what are the benefits? First benefit for home country is, home country means suppose Microsoft invest in India, then the home country will be US. What are the benefit for US? First benefit for US is, in India there are available workforce which may be exploited by Microsoft. In India, the very talented engineers, software engineers are available at a very cheap rate. And this workforce will be exploited by Microsoft. First, it will result in necessary resources which the home country lagged can be sourced from the host country to fuel the growth of the enterprise, which otherwise might have been stagnated. As a result of which, many software companies are now investing in Hyderabad, in Bangalore. Bangalore is the second Silicon Valley for US IT companies. Okay. Next, what are the benefits of the FDI for farm? For the farm itself, the farm gets the benefit of diversification. What is diversification? And do not put all your eggs in one basket. That is known as diversification. With the help of FDI, the farms can diversify their country risk. They will diversify their investment across geographical regions so that it reduces the systematic risk of the organization. It reduces the political risk of the organization. So these are the benefit of FDI for home country as well as host country. Next, we will discuss different consideration in FDI projects. We know that while making foreign investments, particularly in FDI, where the funds are parked for a longer period of time, apart from profit consideration, the foreign firms consider many other factors. First factor they consider is political stability. This is the most important factor to attract FDI. FDI will flow to those countries where there is political stability, where there is no political doldrum, where there is no policy paralysis. When policies cannot be predicted, FDI will not go there. In order to attract FDI, there must be political stability. So, political stability gives guarantee to the foreign investor that their money is safe. And the policy will not be changed in near future. There will be no risk of nationalization or expropriation risk. So political stability must be considered. Second thing which foreign firms consider is a legal validity. What is legal validity? You know that all the FDI must obey the rules, regulations of two countries. What are the two countries? One is home country laws and foreign country or host country laws. So the FDI investor has to appraise or has to fulfill the laws of both the countries. So the legal hurdles may affect the FDI. Let's take an example. In India, in multi-brand retail, 100% FDI is not allowed. Many countries put restriction or caps on FDI. They put certain restriction. So those must be appraised before putting money in case of foreign investment. Third consideration is economic consideration. What is economic consideration? These are the benefits, economic benefits. Okay? These are the financial benefits which a firm obtain. The financial benefits may be in quantitative term or non-quantitative term. You have to appraise those. Next, we will discuss evaluating foreign investment opportunities. Foreign investment or foreign direct investment or FDI investments. While doing FDI investments, we have to appraise the investment. Appraise means before putting money, we have to find out the feasibility or economic feasibility of the new project. How to find out the economic feasibility of the foreign projects? We know that in finance we have a technique known as NPV, net present value technique. What is net present value? Net present value is the difference between present value of cash inflows of the project and present value of cash outflows of the project. This is the way NPV is calculated. NPV is the present value of this. The formula of NPV is this. What is the NPV? This is present value of inflows plus what is this? Present value of terminal values. And what is this? This is present value of outflow. This is the concept. How NPV is calculated? Present value of inflow plus present value of terminal values minus present value of outflows. If you apply this formula, you can find out NPV. Now, while calculating NPV, you have to know that we have to accept those projects where NPV is positive. That means if we have to accept those projects where NPV is greater than equal to 0, and we have to reject those projects where NPV is less than 0. This is the common technique which we apply to appraise any capital budgeting project. But foreign capital budgeting projects, in case of foreign projects, this NPV technique cannot be applied to international projects due to added complexity associated with tax burden and different financial practices followed by foreign firms. So in that case, we have to use a extended version of NPV. We'll discuss that extended version of NPV is known as APV, adjusted present value. So in case of domestic projects, we normally use NPV, whereas in case of foreign projects, we normally use APV technique. What is APV? Adjusted present value. What is that technique? I will discuss later on. So in order to understand the nature of accurate approach, we know that we have to find out the difference between domestic capital budgeting techniques and international capital budgeting. So there is a difference between domestic capital budgeting and international capital budgeting. Why the difference arises between domestic projects and international projects? We have to understand those before discussing the APV technique. First is parent versus project cash flow. What does it mean? It is very important. Parent versus project cash flow. Now, in case of domestic business, the parent company and the project situated in one country. So, suppose there is India and project is in India. So, this is project. In case of domestic business, this project is financed or investment is made by a domestic player. So there is no difference between parent and project. But in case of international business, the parent is in US. Let's take an example. US company invest in India. So the project here and the parent is here. Parent company is here. The cash flow of the project and the cash flow of the parent are different because there are certain restrictions on taking back the cash flow of the project to parent country. So the cash flow for the project and the cash flow for the parent are different. I am giving an example. Let's take an example. Suppose you have a house in India. You give the house on a rent and you get a rent of 5,000. So your rent is 5,000 but you receive 5,000. So the project cash flow and parent cash flow are same because both reside in one country. But if both reside in different country, the parent cash flow and project cash flow will be different. How? Suppose in India a person gives you 5,000 rupees as rent. A US citizen has a house in India and it is put on rent for 5,000 Indian rupees. Now the US citizen wants to take this rent back to USA. While taking back to USA, it cannot take it back directly. It has to go through some banking channels and the bank will charge some commission. So the 5,000 rent will be 4,800 for the parent. But for the project, the cash flow is 5,000. But for parent, it is 4,800. Let's take an example. Indian government put a restriction that 20% of the rent cannot be taken back to parent company. It has to be reinvested in the same project. That means 5,000 cash flow, but you cannot take back 5,000. You will take back 20%, you will put here and you will take back 80% only. That means 4,000 you can take back, but there are certain banking commissions. So you will get 3,800. So the parent cash flow and project cash flow are different in case of international projects. And the project must be feasible from parent perspective. If the foreign project is not feasible for parents perspective, the parent company will not put money. Hence, there is a difference between parent cash flow and project cash flow in case of foreign projects. Why the difference arises? The difference arises because of nature of legal framework in host country. Because of foreign exchange fluctuations, there can be difference between expected cash flow from the point of view of parent, that is investing enterprise, and the project. That means all cash flow on the balance sheet of project may be transferable to parent firm in a financially feasible manner. But there are certain tax regulations, there are certain exchange controls applied by host country and host home country. Therefore, then there must be cost of transfer of money which must be made through banking channels which are to be borne. There may be foreign exchange fluctuation which has a significant impact on the profitability endeavor. Therefore, we know that parent cash flow and project cash flow are different. While evaluating the foreign project, we must have to consider parent cash flow. The project must be financially viable for parent perspective. Therefore, we use a three-stage analysis model. Three-stage analysis model. Three-stage analysis model for foreign projects. A question normally comes, what are the three-stage analysis model for foreign projects? What are the first stage, second stage, third stage? In first stage, project cash flow are computed from overseas subsidiary point of view. In second stage, project cash flow are computed from overseas parents point of view. In third stage, MNC consider the indirect benefits and cost that is associated with foreign investment. So you have to make three-stage analysis. First, the project must be financially viable from the point of view of the subsidiary company. Second, the project must be financially viable from the point of view of the parent company. Third, the project must give some sort of indirect benefits to the parent company. What are the indirect benefits? Indirect benefits means whether it results in some incremental cash flow to the parent company or not. So these are the three-stage model of valuation of foreign projects. First stage, we have to value the projects from subsidiary company's point of view. Second, we have to value the project from overseas parents company's point of view. Third, we have to value the indirect benefits associated with foreign projects. These are the three-stage model for valuation of foreign projects. Next, we have to consider certain tax considerations in foreign projects. Tax, we know that the cash flow of foreign projects are subject to two types of tax imposed by two governments. What are the two governments? First, the tax is imposed by host country. Host country puts the tax. Then the benefit is taken to home country. Next, the home country also put tax on the residual incomes which is repatriated to the home country. So there will be two types of tax, and while evaluating the foreign projects, these two types of tax must be considered. Okay, next, multinational exchange control. It must be considered. What is multinational exchange control? This exchange control are government imposed control and restriction on private transactions conducted in foreign currency. Certain foreign country government put restriction on repatriation of the profit. What is repatriation of the profit? Taking back the profit from foreign project to the home country. That is known as repatriation. The repatriation laws must be analyzed in case of foreign projects. Next, we have to consider tax holidays and subsidies. In case of foreign project, in order to attract foreign projects, certain tax holidays and tax subsidies are provided by host country. What is tax holiday? Normally, holiday is for some days or some year. Tax holiday means the host country provide tax holiday for 10 years. It means it decide not to take tax for the initial 10 years. This is tax holiday. Sometimes host country provide subsidized rate of interest, subsidized loans. The loans can be provided for foreign investment at a subsidized rate. So these tax holidays and subsidies must be considered. So tax holidays and subsidies must be considered. The tax holidays are for some certain number of years, and the tax subsidies are provided by host country government for foreign projects. These subsidies play a key role during establishment of foreign projects, and it must be evaluated. Okay, the foreign subsidies are not only provided by host country, but these foreign subsidies are also provided by various trans-governmental organizations. What is trans-governmental organizations? These are Multilateral organizations like World Bank, like IMF, also provide certain subsidized loans for foreign projects in LDCs. What is LDCs? Least developed countries. Next consideration you have to consider that is cannibalization. What is cannibalization? In case of foreign investment, a concept called cannibalization. Let's take an example. Suppose a US based exporter is sending goods to India permanent. This is USA and this is India. The investor is exporting goods. Now now the firm decide to set up a plant in India. Once the plant is established here, what will happen? There will be cannibalization of export. The exports will be stopped from USA to India. And if cannibalization occurs, the farm or plant put in USA will be underutilized or unutilized. And this process is known as cannibalization. So, while deciding foreign investment, undertaking a foreign project to supply the market would, as a result, cannibalize on the current supplies of export that are already functioning. The firm must consider the cost of back-end production capacity and lost export before reaching final decision to invest or not. So these are certain factors which must be considered while taking foreign investment decisions. Next, the foreign investment decisions is made with an approach. That approach is known as a refined NPV approach, that is known as APV approach. What is APV approach? Adjusted present value approach. Now the adjusted present value approach is just equal to NPV approach but in a refined manner. In case of NPV, the cash flows are discounted at a rate. That rate is known as cost of capital of the business, or that is known as weighted average cost of capital, or WACC. It is used as a discount rate for discounting, for calculating the present value of cash flows. But in APV model, while discounting the cash flow, we have to use the discount rate as an all equity rate discount rate, which is known as K star. In APV, the discount rate is used is K star. What is K star? K star is the all equity discount rate. And this discount rate, K star, is based upon a model. That model is known as CAPM model or CAPM model. That is capital asset pricing model. How K star will be calculated? K star is equal to RF plus beta into RM minus RF. What is K star in this concept? K star is all equity discount rate. What is RF? RF is risk-free return. And what is beta star? It is important. This is all equity beta or unlevered beta. How unlevered beta will be calculated, I will tell. And what is RM? RM is equal to market rate of return. And what is RF, risk-free return? And RM minus RF is known as market risk premium. So in this formula, we understand everything except beta star. What is beta star? Beta star is all equity beta. How beta star will be calculated? Beta star will be calculated with the following formula. How beta star will be calculated? Please see, beta star will be calculated with the help of following formula. Beta star is equal to beta e divided by 1 plus 1 minus tax t into d by e. What is beta star? On levered beta. What is beta e? Levered beta, normal beta. And what is t? T is firm's marginal tax rate. And what is d by e? D by e is the firm's debt equity ratio. So before calculating APV model, we have to calculate the discount rate for APV model. And the discount rate for APV model is known as K star. And K star will be calculated with the following formula based upon CAPM model, that is RF plus beta star whole into RM minus RF. What is K star? It is all equity discount rate. What is RF? Risk-free rate of return. What is beta star? All equity beta or unlevered beta. What is RM? Market rate of return. What is RF? Risk-free rate of return. What is RM minus RF? Market risk premium. How beta star is calculated? Beta star is calculated by the help of following formula: levered beta divided by 1 plus 1 minus t into d by e. D by e is the debt equity ratio. So first we calculate the K star. Once K star is calculated, we apply APV model by following three important steps. These are the three steps of APV model. What are the three? First step? First step is the present value of cash flow after tax before financing cost discounted at K star we will to calculate. Next, we have to calculate present value of tax saving on debt financing, which is known as interest tax shield. And we have to calculate present value of any saving or penalty or interest cost associated with the project financing. We have to calculate these three things, and on the basis of these three things, we have to apply the APV model. What is APV? Very simply, APV is equal to the following four. First, present value of initial investment outlay. Normally it is in minus figure. Plus present value of operating cash flows. Normally these two considers NPV. In NPV model, we only consider these two: present value of investment outlay plus present value of operating cash flow. If we calculate these two, first one is negative, second one is positive, and if the net result is positive, we accept the project. If the net result is negative, we reject the project. But in APV, we make further adjustments of other variables. What are the other variables? Present value of interest tax shield, present value of interest subsidies, any other benefits. If we get its present value must be adjusted with the NPV, and we will this model is known as adjusted present value or APV model. Am I clear? APV model. There is a difference between APV model and NPV model. NPV, a refined model of NPV is APV. NPV plus adjustment for tax shield, adjustment is equal to APV. Adjustment will be for tax shield on interest, tax shield on depreciation, any other adjustment, any other adjustments. If you make all sort of adjustment with NPV data, you will get APV model or adjusted present value model. Am I clear? Now, this APV model is now first given by Ledger in the year 1985 by Donald Ledger. It is a comprehensive way to analyze economic value of a cross-border project by considering multitude of variables covered through formulas. He has taken many variables and adjusted it to find out the APV of the project. In his model, he has taken many things. He has the variables used are spot exchange rate, year of cash flow, operating cash flows, marginal corporate tax rate, cost of equity, project depreciation, nominal domestic before tax borrowing interest rate, present value of concessionary loan, life of the project, interest expenses, after tax terminal value, spot exchange rate, initial investment, accumulated restricted funds, value of concessionary loan, difference between face value of the funds, concessionary loan repayments. All these things, variables he has taken. And he has taken certain assumptions for the model. What are the assumptions? The model assumes that the cash flow to be denominated in foreign currency are to be converted to currency of the parent at the expected spot exchange rate. The foreign currency cash flows is to be converted at expected spot exchange rate ST. The marginal corporate tax rate considered is the higher of tax rate between home country and host country. And the discount rate used is to be based upon K star. These are the assumptions of the model. Now, we will solve a problem on the basis of this model. Let's solve a numerical example on Ledger's APV approach. Example. Let's take the example HTG Private Limited, a MNC based in US, has recognized an opportunity to undertake a project with an initial investment of 6 lakh euros. There will be 6 lakh euros. The investment will be in a European country and it will be in 6 lakh euros, which is expected to return 1,80,000 euro for 3 years. So if you put 6 lakh, you will get 1,80,000 in the first year, 1,80,000 euro in second year, 1,80,000 year in third year. And the plant is expected to incur depreciation of 4,50,000 euros, which will be applied through a straight line method. That means the depreciation charged on the plant is 4,50,000 euros in 3 years. So per year depreciation will be 1,50,000 euros. How 1,50,000 comes? 4,50,000 for the entire 3 years and per year 1,50,000. The company is expected to raise 2 lakh euros through debt. The debt will be 2 lakh euros. And with the key facts given, what is the key facts given? The cost of equity is 0.14. This is the cost of equity. And the cost of debt is 0.11. Corporate tax rate is 40%. Dollar inflation is 8%. In USA, the inflation is 8% and euro inflation is 4%. In eurozone, the inflation is 4%. We know that the country which face more inflation, its currency value will depreciate in comparison to the country where inflation rate is low, and it is given by purchasing power parity theory or PPP theory. And PPP theory, by applying PPP theory, we can estimate the future exchange rate. Next, the issuance cost incurred is 0.1%. What is issuance cost? Issue cost. Issue cost of what? Issue cost of debt. How much debt you have issued? You have issued 2 lakh euro debt. So your issue cost will be 2 lakh into 0.01. That is equal to 2000. Am I clear? 2000 euros will be your issue cost. Then the current exchange rate is equal to 1.0775. Which exchange rate? Euro dollar exchange rate. 1 euro is equal to $1.0775. This is the usual rate. Next, we have to solve the validity of this project by applying a PV model. So what we will do? First, we have to calculate different rates, expected rates. We know that the expected rates will be calculated on the basis of PPP model. What is PPP model? PPP model tells purchasing power parity theory. And under this, ST means future exchange rate, will be equal to spot exchange rate, SO, whole into 1 plus inflation rate in first country divided by 1 plus inflation rate in second country. Okay, so inflation rate in US is 8%. In here it is 4%. We have to apply this. And what is S0? S0 is current exchange rate. What is current exchange rate? We know that 1.0775 is the current exchange rate. So current exchange rate is 1.0775. And the formula is like this. T means year. So on the basis of this, we have to expect the future interest rate for conversion of euro inflows into dollar inflows. So just look at the table. Year 0 exchange rate is 1.0775, which is given. Expected rate is same. Year 1, what will be the expected exchange rate? 1.0775 into 1.08 to the power 1 divided by 1.04 to the power 1. That comes to 1.118942. This is the PPP model. Year 2 exchange rate will be the same formula, but in case of T, we have to take 2. The value comes 1.161979. In third year, the PPP model future exchange rate will be 1.0775 into 1 plus 0.83 by 1 plus 0.04 to the power 3. This is the rate. So it is the future expected rate. 3 years future expected rate is calculated like this. Next, we have to calculate the operating cash flow. What are the operating cash flow from the project? We know that the project will involve a cash outflow of 6 lakh. So 6 lakh is the cash outflow. But this outflow is in euro. And it will generate inflow of 1,80,000 first year, second year 1,80,000, third year 1,80,000. And these euros must be converted into dollar. And what is the exchange rate? Exchange rate with what we have calculated by PPP model. We have just calculated this PPP model and find out 0 year exchange rate 1.0775, first year exchange rate 1.1189. We have calculated this 1.1189. Next year 1.161, next year 1.206. These are the exchange rates 1.1602 to 1.02067. And if we convert it, we find out dollar based exchange rate. How to find out dollar based? 6 lakh into 1.10075. This is $1, 1 euro is equal to this much dollar. These are dollar. So if you multiply this, you find out this much dollars. These are the cash flows in dollar. And these are to be discounted at which rate? All equity exchange rate. What is the all equity exchange rate? We know that the all equity exchange rate is 14%. So we have to use 14% cost of equity for discounting. So you put all equity exchange rate 14% and you find out present value interest factor, PVIF. How PVIF is calculated? 1 divided by 1.14 first year. 0 means 1, next is 1 divided by 1.14. Next year, this figure divided by 1.14. Next year, this figure divided by 1.14. These are the values you get. Next, you multiplied it, you get dollar denominated cash outflow and inflow. First case is minus 6,46,500. Next. If you add this, you get a negative NPV. And this is dollar. This is negative NPV. So if you consider only NPV model, you must have rejected the project. But FPV model tells that apart from NPV, you must consider certain other tax shield into consideration. So the tax shield may be arise because of depreciation and interest. Now, what is the depreciation amount? Please see, what is the depreciation? Depreciation amount is first 0 year 0. First year depreciation 1,50,000. Second year depreciation another 1,50,000. Third year depreciation 1,50,000. Next, what is the tax rate? Is 40%. If you multiply depreciation to tax rate, you will get tax shield. The tax shield will be 60,000 first year, second year's tax shield 60,000, third year's tax shield 60,000. But the tax shield is available in euro term. You have to convert it into dollar term. How to put it? You have to use exchange rate. 0 exchange rate is this. First year exchange rate is 1.1189. Next is 1.1620. Next is 1.2076. Next, you have to multiply this. You will get dollar denominated tax shield. Once you get dollar denominated tax shield, you have to depreciate it. You have to find out its present value. But please see, its present value will be calculated on the basis of cost of debt, not on the basis of cost of equity. What is cost of debt? Cost of debt is, in this case, cost of debt given is 11%. So you have to discount this at 11%. If you find out 11% PVIF, the values will be like this. 1 divided by 1.11. Next will be again divided by 1.11. Next will be again divided by 1.11. You get all these figures and you multiply this, you will get present value of tax shield on depreciation in dollar term. If you add this, you will get 1,70,007. This will be depreciation tax shield. Similarly, there can be interest tax shield. Interest tax shield is calculated by taking debt. You have taken a debt of 2 lakh and the rate of interest is 11%. So the interest payment is 22,000. So every year the interest payment 22 is there, and there is issuance cost. Issuance cost is 2,000. I have told it is to be made in first year. Next, interest payment is to be made 22,000 into 40% is tax shield. What is 40% tax rate? That is equal to 8,800. So you get 8,800, 8,800. But all these things are in euro. You have to convert it at an exchange rate to dollar. So exchange rate year 1, year 2, year 3 we have calculated, and you have to just multiply it, and issuance cost is in negative figure. So you get the values in dollar. Next, you have to discount it. So by using cost of debt is 11%. You have to discount all these things at 11%. And you get interest factors like this. When you multiply it, you will get cash flow of home currency in dollar. This is first case is minus 2,000 because it is a cost. Next one is interest tax shield. This is issuance cost. And this is interest tax shield. If you add these two, you will get this much. So the APV value of the project will be operating cash flow negative, depreciation 1,70,007 positive, debt interest tax shield 22,934. This is tax shield on depreciation. This is tax shield on interest, and total basis it is coming positive. But if you consider only NPV model, you may reject the project. But if you consider APV model, you will accept the project. So in our today's class, we have discussed regarding international capital budgeting. These are certain self-assessment questions on international capital budgeting. What are the options available for foreign investment, cross-border investment, how it is different from domestic capital budgeting, what is the benefit of FDI for host country and home country, what is the difference between APB and NPB approach. So this is one problem, you can solve it at home. These are the sources for further reading on this topic. Thank you for attending my class. Thank you all.